I figured out that actually in the last class I skipped some slides, so I'm sorry about it. I was confused with the earlier class, and I didn't mention what are the overall performance measures. They are return on assets, return on equity, and ROIC that we learned in the last class. And one thing that you should know before we go further is that we can decompose ROA and ROE into 2 or 3 components. So ROA can be calculated as profit margin times asset turnover, and ROE can be calculated as the triple multiplication among profit margin, asset turnover, and equity margin. It is very simple, so let me just briefly show it mathematically. So ROE is net income divided by equity, and you can multiply the same numerator and denominator. So I'm going to multiply A over A, assets over asset, and I'm going to replace them. So you get net income over asset times asset over equity. So net income over asset is, by definition, it's ROA, and asset over equity is equity multiplier. And we can further decompose ROA into 2 components because it is net income over asset. I'm going to say that it is net income over asset times sales over sales. So if we change these 2 positions, we get net income over sales times sales over asset times equity multiplier. And then net income over sales is profit margin, and sales over asset is asset turnover, and we have equity multiplier. So therefore, ROE can be represented as profit margin times asset turnover times equity multiplier. So therefore, if you want to increase your ROE, you need to have a higher profit margin, you need to have a higher asset turnover, and at the same time, you need to have a higher equity multiplier. So it was very simple mathematical formula. And here it goes. So we discussed the validity of ROE, and we found several limitations in ROE. And then if we understand the limitations, then we don't have to worry too much, and then we can use it as a proxy or a measure for your overall financial performance. And today I'm going to introduce several, precisely 3 cases. The first is in your textbook. It is about the Hasbro. Before we start, I'd like to emphasize that in ratio analysis, there is no absolute value which is correct. So it is not a mathematical problem whether you need to say true or false. So on the contrary, it can be said as a horse race, so competition with others. So therefore, you need to think about what will be your benchmark. So you need to basically compare your company's ratio with others' ratio. And there are 2 kinds of approaches you can use. The first is called cross-sectional analysis. So in cross-sectional analysis, you compare 2 companies or more companies in the same period. For example, you compare Apple, which produces iPhone, with Samsung Electronics, which produces Galaxy smartphone. And then you have to compare it for the same year so that they had the same similar performance otherwise. And the second approach is to observe a change in the performance as time goes by. So this is called time series analysis. In time series analysis, you calculate the company's ratios for each year, for example, for 2 years, 3 years, or 5 years consecutively, and then you compare the trends. So you find out the trends, whether the company is doing better and better, or whether the company is doing worse or worse. So in reality, we often mix these two approaches. So we not only just we calculate the same company's ratios for some 3 years or 5 years, but also we at the same time we calculate the competitors in the same industries ratios together to get more comprehensive understanding about the sector or the industry. So for the Hasbro's case, the textbook provides us the financial ratios starting from 2012 to 2016, and for 2016, it also gives us the industry average, which are the companies' average, which are on the same industry with Hasbro. And we can find the financial ratios that we learned. For example, ROV, ROA, ROIC, profit margin, asset turnover. In here, assets to equity is basically what we call equity multiplier. And let's compare them. So if you look at the ROE, so in early 2012, the ROE was 22, and in 2013 it was only 17%. However, in 2016, it has become 29.6, which is almost 30%. So there is an increasing trend in ROE. So we can say that Hasbro's performance has improved. And at the same time, if we compare the number with its peer average, and we get the same conclusion that Hasbro is doing well compared to its competitors, because almost double score we have. And maybe some of you can think that maybe this is just because Hasbro is using a lot of leverage, and partially it is true. So if we take a look into the assets to equity, which is the equity multiplier, Hasbro's equity multiplier ranges from 2 to 3, but on the contrary, industry average is lower than that. So therefore, we can argue that ROE of Hasbro is slightly higher than its peer because the Hasbro is using more leverage. So because ROE is calculated as profit margin times asset turnover times equity multiplier, because we have a higher equity multiplier, ROE is higher. So it is a mechanical calculation. However, it is not true. The actual performance, the operating performance, has also improved, as you can see from the profit margin and asset turnover. So if we compare the profit margin in 2012 and 2016, it was only 8 and it was only 7, but now it's 11%. So we have an improvement in cost managing of the company, and now it is very close to its industry peer. And at the same time, the asset turnover is almost 1, which is higher than its industry average. So therefore, we can conclude that Hasbro's performance has improved, and basically we can find it from the ROE. But this is not just because of the high leverage. If we go back here, we can also compare ROIC. Yeah.
What is
Can you say louder?
Yes, there is an exit test line. What is it?
Exit test.
Yes.
Okay. I forgot the definition, but it is about the current asset. So it is comparing whether you have enough current assets to pay out your current liabilities, I guess. So maybe you can find the more formal definition from the textbook. Okay. So if we check the ROIC, so remember that ROIC is removing the effect from the leverage and focusing on the actual operation. And then ROIC is also higher in Hasbro compared to industry average. Therefore, we can say that the higher ROE is not coming from the leverage. And then there are several reasons. First, there is a profitability issue. So profit margin is higher. And second, if regarding the asset efficiency, it has a higher asset turnover than its industry average. And we can also take a look into other measures as well. For example, even though I didn't mention it during the class, we can calculate the fixed asset turnover, and then it is very high compared to its industry average. It means that, especially for the fixed asset, it is very using its fixed asset more effectively. For example, it is having a smaller size of fixed asset, for example, facilities to produce their products, but they are using those assets more effectively. And the last reason can be, and it's partially, it can be due to the leverage, but of course, because it has a higher leverage, we can say that there's some slight effect coming from the leverage. And at the same time, we need to understand, we should note that because the higher leverage can be a potential risk in the future. So we have done basic ratio analysis, and this is not the end. So the reason that we are doing this ratio analysis is because we want to know about their performance, and as shareholders or investors, because we want to know which company we should invest. And if we are in a management team, we should do the financial ratio analysis because we want to improve the firm's performance. So let me just check whether those results from ratio analysis are consistent with the reality. So actually, those Hasbro's seemingly improved financial performance is not just seemingly, but it is actually affecting its reality for their shareholders. So they announced the financial statements on February 6, 2017, and on the same day, stock price of Hasbro has increased 14% because investors thought that Hasbro is doing well, so they had some willingness to purchase this stock. And for the next 5 years, Hasbro earned a lot of money because its production and sales was very good, and because it had a lot of cash, it was able to redistribute the cash to the shareholders through stock repurchases and dividends. So therefore, they were able to, their shareholders in aggregate, they were able to receive $2 billion from the company. So this evidence shows that our ratio analysis is not just for the textbook, but also for the reality. So I selected two companies, one from Korea and one from the United States. The Korean company is Ottogi, which is a food manufacturing company, and the second US company is Netflix. So basically, I chose those two companies because recently I had opportunities to use their products or services. I ate some ramen from Ottogi, and then I watched the Narcos Saint from Netflix last week. So I wanted to check whether they have some kind of financial issues or not. So let me start with Ottogi. So Ottogi, many Korean students will know, but not international students. So let me introduce Ottogi Corporation. So Ottogi Corporation is a food processing firm, and it sells products such as curry, tasting sauce, and ramen noodles in Korea. And it is taking the second place in ramen industry, and the first place is taken by Nongsim. So Ottogi sells 진라면 and Nongsim sells 신라면. And its latest semi-annual report was released on August 16, 2022. So recently, they released new financial statements, and we got an opportunity to analyze it. Selected several important information from balance sheet and income statement. So according to its balance sheet, assets worth 2,700 billion Korean won, and equity some number, and net sales blah blah, and net income so on. But here, one thing that you should note is that this is a semi-annual report. So it is reporting the financial performance only for the 6 months starting from January 2022 to June 2022. So therefore, even though you didn't have to care about the time matter in your textbook problems, in reality you need to be very careful because some items are not representing its performance in a full picture. So for example, those you may not get any problem for the balance sheet item because balance sheet is like a snapshot. So it is not about a period, it is just a point of time. So actually there will be just the difference in the point of times. However, regarding the income statement items, you have to make sure that you are thinking about the same period. So this is for only 6 months. These numbers are only for 6 months. So if you are thinking about the annual performance, then you have to multiply 2 to get a correct number. Or there could be other ways to adjust those numbers, but I'm just going to simplify the problem and then I'm going to multiply 2 for this matter. So when I calculate the ROE, I like to show it in annual basis. So what will be their annual ROE if their trends goes on? So I just assume that for the next 6 months, they will get exactly the same number from their sales and net income. And then ROE will be 2 times the net income divided by the equity. So therefore, I can get 12%. And similarly, for profit margin, the numerator is net income and the denominator is sales. But these two items are from income statements, so I just multiply 2 on both sides. But luckily, we don't have to care 2 here because actually they will be canceled out by each other. So we get 6% profit margin. And for asset turnover, again, because we have sales on the above of this ratio, so we need to multiply it by 2 to get a correct answer for this calculation, and we get 1.12. And finally, we have equity multiplier. However, because these two items are from balance sheet, not from the income statement, so we don't have to adjust it for annual basis, and we can just use this number. So these are the basic ratios from the ROE framework. And because I want to know about the performance of Ottogi in this half year, I do two approaches together. So I calculate the same ratios in the last year, and also I calculate the ratios for Nongsim, which is its competitor. And I can do it by taking a look. I did it by taking a look into the financial statements in the last year, and also the financial statements of Nongsim, and I get this as my result. So I have 3 columns. Ottogi this year for the half year, the first half of 2022, and the first half in the last year, and Nongsim this year. And first, we can get a time series analysis by comparing these first two columns, and we find that Ottogi's performance in terms of ROE has improved from 9.5 to 12.5. And also, it is surprisingly high compared to its competitor, the biggest competitor, Nongsim. And the reason is because basically profit margin has increased from the last year, and also it is larger than its competitor's profit margin. So we can find the significant increase in ROE, and the major reason is because of the successful cost management. So you have to understand that profit margin is about the cost management. So profit margin is you start from sales and then you leave with net income. So what happened in your process? So those are called expenses and cost. So you are considering about the cost structure of the firm. And if you have a higher profit margin, it means that you are not paying too much for the cost and expenses, therefore you get more profit. And secondly, if we take a look into the asset turnover, it has a slightly larger asset turnover than its competitor, and it is not because of high leverage. So let me go back to the previous slide. So you can say that if we do not take a look into the second column, you can say that, okay, look here, Nongsim has equity multiplier of 1.3, and Ottogi has equity multiplier of 1.7. So basically, Ottogi has a lot of leverage compared to Nongsim. So this is one of the reasons. However, you cannot interpret it this way because of the second column. So if we compare the time series trend, so basically you can find actually Ottogi's equity multiplier has decreased from 1.8 to 1.7. So you cannot argue that the increase in the ROE is coming from the leverage, right? So therefore, I'm trying to say that this is not because of the high leverage. And what happened in the market? Earnings surprise. So investor reacted to the announcement very positively, and they started to buy the stock. So more precisely, on August 16, the open price, the starting price was 465 and 500 Korean won, and at 4 p.m., the closing price, the end price of the stock was 472,000 Korean won. So if you have bought the stock on the beginning of the day and then you sold it at the big end of your day, then you were able to get a return of 1.4% in a day. So if you invested 10 million dollar, then $1 million, then you were able to get 40,000 Korean won in a day. So it is not a small number for a day. And also, if you hold it for the next day, the closing price of the Ottogi became 485,500 Korean won. So for 2 days, for 2 consecutive days, you were able to get a positive return of 4.3%. So we can see that, yes.
Is it quite high or low? Because like when I calculate, for example, if I put 200 euros, at the end of one day I have 202 euros. Like how much do you measure is good or not?
So okay, so if you have no idea about whether 1% return is high or not in a day, let me imagine that you earn 1% return every day for a year. It means that I didn't calculate it, but actually it's like a lot of money you can make. Okay, so because even though the 1% seems small in number, because this is just for one day, actually you are making a lot of profit. Okay, and all right. So what we can find from this Ottogi's case is that actually, if you had a chance to read their report on the release day, then you were able to make some money. So basically, it is meaningful to conduct those financial analysis. Okay, and I'd like to talk about the Netflix case. As you might already know, Netflix is an over-the-top media streaming and production firm. So here, the term over-the-top means it doesn't require you to have a top set in front of your TV to watch the video, but rather you can just access free internet and get the streaming. And Netflix has more than 200 million subscribers around the world, and in terms of its market capitalization, it is the second largest media company after Walt Disney. And its first quarterly report in 2022 was filed on April 21, 2022. And for your precious time, I have made summary of their income statement and balance sheet. And then what I'm going to do is to calculate the same ratios, but again, we have to care about the timing, the period issue, because in the United States, all companies need to report quarterly and annually, and this is a quarterly report. It means that it is only taking care of the first 3 months, January, February, and March. So therefore, if you want to use it like the annual ratios as we did, then you have to multiply 4, or you have to take care of it in using other ways. But there is no clear answer for it, so you can, for your purpose, you can adjust method. But here I'm just going to assume that for the next 8 months the performance will be the same, and I'm going to multiply 4. So in the calculation of ROE, I multiplied 4 to the net income to get the ROE on annual basis, and its ROE is very high, as much as 36%. And similarly, for the profit margin, it is 20%. And asset turnover, because this numerator is sales, which is from the income statement, and so we need to multiply 4. But because the denominator is asset, which is from the balance sheet, we don't have to multiply it. So I get asset turnover of 0.69. And finally, we have equity multiplier. So although the Netflix largest competitor can be Walt Disney, Disney is often considered as a traditional media corporation. So its size is very, very high. Size is very, very large compared to Netflix. So I think it does not make sense to compare directly Netflix with Disney. So I'm just going to show you a time series trend. What has changed from the last year to this year. So I have 2 columns. Netflix this year first quarter and Netflix last year first quarter. And you can find that actually, although it seems very high, 36%, ROE was even higher in the last year as 52%. And profit margin was also high as 23%. So in comparison, we can get the conclusion that actually Netflix is doing worse compared to the last year's performance. So there was a reduction in ROE, and this is mainly because of the profit margin part, so because of the increasing cost. So if we think about the Netflix situation further, we can guess the following things. First, the OTT industry had a boom during the COVID-19 crisis. So starting from January 2020 to the last year, everyone were required to stay at home and they had nothing to do. So they started watch the videos from YouTube and Netflix and other things. So OTT industry had a boom, right? And because of that, a lot of subscribers Netflix has obtained, and that was the main source of their revenue. However, now the situation has changed. Now, almost every country except Korea is releasing the restrictions for the quarantines, and therefore now people are going out and they don't have to stay home, so they are canceling their subscriptions. And at the same time, every media company, the traditional ones included, they realized that now OTT is the big market. So these companies are entering into this market. For example, Disney recently published its OTT service called Disney Plus. HBO has something called HBO Max or other thing. And in Korea, we have Wave, TV, and other OTT services. So it makes a lot of competition. And then they had to take some market share out of a smaller market. But at the same time, another problem is that they are paying more to the content creators. For example, 2 years ago, they were able to only pay small amount of money to the creators of the Squid Game in Korea. But if they do the same thing now, they should pay more because other companies as well are trying to get those teams, those production teams. So actually they have to pay more to the content creator, which will increase their cost, but at the same time their revenues are decreasing. So that's why maybe they would not be able to get a higher profit margin in the future. So the quarterly report shows an earnings shock. So there was a negative response from the investors. And precisely in 2 days, from April 19 to 21, there was a return of minus 37.40%. So actually, you would have lost almost a third of your money if you invested in Netflix during that period. And so again, this case shows that there is a worth of trying to do financial ratio analysis whenever possible. So if you had a chance to get the information in the financial statements in that period, then if you invested in Netflix before, then you were able to sell those shares before there is a decrease in the stock price. So investors always need to do financial ratio analysis whenever they make choices in their investment.